A very good evening to one and all. I'm Faizan Qureshi from third year IT department. Taking the baton of We Reach Further, we have another dish for you from our wide range of buffet. We Reach, which is a VESIT alumni engagement initiative, aims at reaching out to the alumni and enables the sharing of their knowledge and experience with us recipients. To begin, I would now invite Dr. Shalu Chopra, HOD, IT Department, to address and welcome the viewers.
Good evening, dear friends, alumni, and faculty of VESIT. So we are almost reaching near the completion of successfully running 3 weeks long webinar series. And we at IT department are very happy to be a part of this We Reach program, which is an alumni engagement initiative under the guidance of IQAC, Internal Quality Assurance Cell, in association with IIC, Institute Innovation Council. Our today's speaker is Mr. Nikunj Gala, and he is going to talk about financial planning and role of equity investing. And in that, he is going to cover topics like how one should manage their money, understanding of various asset classes, and how to allocate capital in these classes, understanding of equity investing, and career in finance. So, quite interesting, isn't it? Are you ready? Get set, go.
Thank you, ma'am. Money plays a very important role in our day to day life. But today, the prime fear with every common man is how to save money and fix personal finance mistakes. Some people earn well but don't know how to save, how much to save, and where to save. They all lack one thing, and that is a good future plan to secure their finances. We all need a strong foundation for our strong financial future. And for that, we need to know the dealings to fix our finances and avoid mistakes. So, to help us with this, we have today with us Mr. Nikunj Gala from the 2010 batch of IT department. Mr. Nikunj has worked with TCS for 2 years. Post that, he has completed his MBA in Capital Markets from NMIMS Mumbai in 2014. He's been working as an equity research analyst for the last 6 years. Currently, he is working as an equity research analyst in Principal Asset Management Company serving auto and consumer sectors. Prior to joining Principal AMC, he has also worked with Ask Investments, IIFL, and ICICI Securities. So now, without wasting any more time, let's invite the speaker for today's session, Mr. Nikunj Gala.
Hello everyone. The video was too nostalgic for me, so it took me, some bit of time to get to normal. Um, Firstly, I would just like to thank, Visit, the way we remember our college faculty members and all the student community out there, who are working so hard to get us connected with the, current generation of students to help them, to manage their stuff. So, firstly, thanks to everyone. Um, the day college approached me to get this topic deliver, the first thing which came into my mind, what should I cover in finance? And then I thought, what could be the best thing for the today's generation to have a consideration of the financial planning and role of equity investing. um, because considering the current scenario, what I believe is the rate of financial literacy in India is very low as compare if I compare to any other countries in the world. um, the important concepts like how to manage your money, how to do financing, this is not taught in our typical student college or our school life or in the college life. So those kind of in the setup, our curriculum doesn't cover this important aspect, and we face a lot of challenges on account of that. If I just see the generation prior to us, they didn't had the opportunity to understand about this topic with the advent of the internet. At least our generation has that kind of a thing where we can easily go to the internet and search about these things. So our prior generation faced a lot of issue with respect to that. But even today's generation is not that. When I see 80% of the population doesn't focus much on that. So what is the first thing which, or first kind of a reaction comes in when I talk about the, financial planning? So, if I talk to the today's millennial, they simply just say, I can earn money. So what's the big deal about it? Um, so the only point which I want to tell them, friend, is remember, income is not equal to your wealth. So wealth is a separate thing, and your income is a separate thing. When I talk to the, next generation X, so generation prior to us, which who are in the range of say 40 to above 40 age, they always say, we have already missed the bus. So what should we do now? So there is no point of, talking about the financial planning at this stage. The only point, which I want to, tell them is, no matter of the fact, what generation you belong to. So whether you are X, Y, Z, baby boomer, or today's millennial, the worrying of the personal finance is the most productive thing you can do in the current time of situation where there is a lot of uncertainty, a lot of challenges. So I request everyone to focus on these pointers. See, the topic is too vast. It's very difficult to cover the entire topic into the short span of time, given the limitation of time. But I have tried to put the key aspects. At least it can give you the base on which you can build on in the future. So it can act as an anchor, and hence in the future you can easily develop on that. Few of the things are a conventional one, but few things are unconventional. So there is a caveat here, so I would put a disclaimer that most of my views are of my personal views. If you think they are good to you, I think you should embrace that. Else, I think you can have the other opinions too with respect to financial planning. So let's understand the fundamental question of why financial planning is important. So I've tried to bifurcate this into the 3 pointers. So firstly, inflation. Now I don't want to give the typical definition of inflation from the economics perspective. How inflation affect us is the I just want to tell you in a simple way. It just reduces your purchasing power. Just try to understand from year zero where you are today, and you are buying some kind of a goods and services at rupees 100. After the 1 year, the same goods and services, you won't be able to get that at 100 rupees. So the cost of same goods and services has become 105 rupees. So which eventually means, if your income or your wealth has not grown at the rate of say 5%, it has reduced your purchasing power. So the same kind of a goods and services in the year zero is not, you won't be able to buy the same at 100 rupees, or the same 100 rupees won't be able to give you the same goods and service which you bought in the last year. So hence it just reduces your purchasing power. We always read in newspaper the inflation is growing at 4% rate or 5% rate in the last 2 to 3 years. But I just want to make one thing clear, that inflation consider a government which reports in the media has some kind of goods and services in their basket. However, your goods and services which you consume might be different from that. So 4 to 5% of inflation rate, which is which you see in the media, might not be the applicable rate to you. So just imagine the same goods and services which you used to buy 4 to 5 years back, how much it is costing, you will get the percentage return. So just to beat that kind of inflation, I believe you should have a proper financial planning. And if your salary rate, just consider today's fd rate fd rate as rates are at 4 to 5%. Salary rate growth or personal income growth at the GDP level is growing at a mere in the nominal term would be 5 to 6%. Then how to cope up with this kind of inflation if you haven't planned the financial planning uh, in your career? I was just when I was thinking on the inflation point, I remember when I joined engineering college in the year of 2006. At that point of time, all the IT companies used to had the initial packages for the freshers in the range of 3 to 3.5 lakh. And after 15 years of that, today at 2020, still those IT companies are still having the freshers package at the 4 to 4.5 lakhs. So there is, if you just compute the rate at which the income has grown for the freshers, uh, just like to like comparison, if I want to make, it's hardly 1 to 2%. But my cost of living, or the expenses which were in the 2005, and if I compare it with the 2020, they have grown drastically higher. So the same 3 lakh won't be able to help me in the saving and investing. So hence one should just focus on that. The second point, why financial planning is important, is to have the post retirement life to be very peaceful, where you don't have to worry on the financials. The worry for money should be the least important thing post your retirement. Just to give you the perspective, look at this chart of the life expectancy in India from 1960 to 2014, or till date. It is continuously increased. So this can be on account of there is significant increase in the medical science, then lot of things, availability of goods and services, availability of your medical facilities have improved. Hence your anyone's financial life expectancy has improved drastically. So earlier people used to live for say 40-45 years in 1960. Now they are living to 65. So which eventually increases your retirement life. Say your if I just want to see your number of years of earning, you would be retiring at 50-60. Then your retirement age would be say the life of during the retirement would be much higher. So hence you require good financial planning for that. Look at this chart, which says, say when you are in the age of 25, the human capital, which is the salary income, would be much higher. Your savings set would be much lower. But with the age, your human capital will increase drastically. And if you haven't saved the from the initial year, then your total wealth, which is required at the during the time of retirement, you won't be able to fulfill your all the needs at that point of time. And thirdly and lastly, which is very important, and when you speak to this point with your parents, that you want a financial independence at say at the age of 40 and 45, there would be clear they'll say, what are you talking about? At the age of 40, why you want to get retired? But at the same time, you might have to consider the points like you also want the freedom to pursue your passion. You also need to buy time with your family and friends. So if you have done financial planning at a very peculiar way, then I think there is a high chance that you can achieve the financial independence at a very early age. Remember, the point which I'm making here is the more of a financial security. It doesn't mean that you have to make a lot of money. The point here is, if you are financially secure, then the worry of finance or worry of money becomes relatively very less at the later stage of your career. Okay. And just um, on the retirement point, which I just mentioned, where your retirement is very high, uh, the environment in which we are currently living, it's highly uncertain. Currently, we are facing with the pandemic. There are a lot of disruption going on. A lot of competition, a lot of automation is happening. So uh, the typical life cycle of a person to earn used to be, we used to have the retirement at the age of 58 or 60. But all on account of this disruption, competition, automation, it in the next 20 years you might see your working life reducing day by day. Then to have that kind of corpus to manage your money, I think that becomes very much important. And remember, your child can get the all kinds of loan, whether it's education, car loan, but you won't be able to get the retirement loan. So to focus on your retirement corpus, to make it as a priority, is a thing which you should remember. And the real idea is that if you save and invest diligently, you should reach a point where money worries are very rare. However, when I say this point of financial independence, and you want to be retiring at a very early age, make sure you be still working physically and mentally. The only way to live longer is to be busy with physically and mentally. That's the secret of long life too. What's the solution for this? If I just anyone asks, then how should we go about it? So the saving and investing is the only option which you have right now. The save and try to invest in such a way that it meets your future goals. So how the saving equation which we have learned over the period. So general equation, when everyone says you earn the income and you spend on your all the expenses, whatever remaining is there, you just save. I think that's not the equation which you should look for. The more sensible equation is whatever you earn, try to make sure that significant amount of that money goes into savings, and the remaining part you should think of it is as spending or your expenses, whether it's for your need or as a need, or whether it's for the luxury items. So the general and more sensible equation would be you save first whatever income you have and then spend. So what's the secret to get wealthy? I hope you might all must have watched this movie of Kung Fu Panda. If you haven't, I would really urge you to watch all the three version of the movie. In this conversation where he's asking his father, "What's the secret recipe you have?" And father just says, "There is no secret recipe. You just have to believe." And the same goes in personal life. So how one should get wealthy, you know so there is no secret recipe, you just have to believe. So believe in what? So believe in the start early. So whatever you earn at the early age, save reluctantly, save as much as you can, and the from remaining part just spend whatever for your need and the luxury part. Now whatever amount you have saved, try to invest a little by little over the period of time, and that amount will compound significantly. And you have the as Einstein has mentioned, the power of compounding. Compound interest is the eighth wonder of the world. So that compounding effect will have significant impact on your wealth over the period of time. So that's a secret. That's the only simple secret which you should follow in your life. So as I mentioned, Albert Einstein's compound interest is the eighth wonder of the world. So the one who understands earns that, and one who doesn't, pays for it. So we might have learned this, simple equation of compound interest in school. Future value equals to present value into 1 plus interest raised to number of years. Now this is a very simple and the fundamental, equation you should be remembering when it comes to financial planning. If you remember this and apply it in your day-to-day life, I think the lot of things get sorted out. So how this power of compounding functions. So let's take 10,000 rupees or 10 lakh of rupees. If you invest this money for say 20 years at the 8% interest rate, then they look at the amount which you get after 20 years. So 10,000 money has goes to 4.6 lakh, or if you say 10 lakh money goes to 4.6 crore. It almost becomes 4.6 times. That's the power of compounding one have. Uh, so just remember this. So present value into 1 plus interest rate raised to number of years gives the future value. And just reverse this equation. In future, say you need say 100 rupees after the 5 years. So what kind of a money you should invest currently so that you get 100 rupees in the fifth year? So just reverse this equation, you will get the answer. So So now the focus comes to how one should go about the financial planning. Um, so before coming to investing, I would urge you to focus on this slide. It's a very critical one, and which many of us ignores in our normal course of life. Firstly, firstly you just have to have the emergency fund. uh, Typically the thumb rule, I'll make sure I'll give you a thumb rule in all the situation. The thumb rule for a emergency fund is 12 months of expenses. So now this money you should be keeping in your savings account, irrespective of whatever your requirement is. You should not touch this money. This money you should be clearly looking for, whenever there is some kind of emergency, so that you have something to fall back on. Look at the current situation when there are n number of job cuts or salary cuts. In that kind of a situation, if you could have have this kind of emergency fund, it surely helps you. Why 12 months? Because it gives you enough time to fall back to another job, or fall back to any other business you can start with. So this is a very crucial one. The second point which I would like to highlight here is medical insurance. Now, why one should have this kind of medical insurance? A lot of people when I speak to, they just ignore this point, and they say it's very high expense for me. The kind of medical science inventions which are going on, the day by day, the cost of your medical all expenses going increasing day by day. When I mentioned the life expectancy is increasing on account of with the advent of medical science, there is a cost attached to it. So I would urge you to focus on your medical insurance. Even if you are doing job and your company has some kind of a medical insurance arrangement with any company, still I would prefer you to have the personal medical insurance. If you are in future, you start your family, the four adults, or two adults and two kids, you can you can go with some short of 10 lakh rupees. That's the initial money you can start with. And for your parents, I would urge you to have the independent medical policy of 20 lakh rupees. Now for the for your parents to have a medical insurance of 20 lakh, you just need per month of 2000 rupees. Now that, remember, this 2000 rupees, don't consider it as an expense, consider it as an insurance expense. Now this can help you in the future during the uncertain time. And thirdly, life insurance. Now, the life insurance, you should only focus on the term plans. There are a lot of plans which goes in the market, like you have a ULIP fund or endowment fund. The only advice I would give at this point of time: never confuse your insurance with investment. Consider both as a very different part. In insurance, don't think of any return in the future. Okay, so if you go for endowment, where you expect after the policy gets over you get money back. If you just count with the help of time value of money, if you just consider what kind of a return you are generating from that, it's mere 5 to 6%. So that kind of a return you should not be looking for when you are doing investment. At the same time, the insurance money is too low during that endowment plan. So it's better to go for the term insurance plan, where it should be approximately 15 to 20 times your annual income. So if you are earning 10 lakh rupees, I think 1.5 to 2 crore should be your term insurance. And term insurance, if you start early, you will have advantage. The premium which you have to shell out would be not that great. So just if you are of the age of 25 and you start 1 crore term insurance, the per month cost would be hardly 600 to 800. So that's a very low cost, but at the same time your coverage would be higher, and I think that's a good thing to have for your family. So after considering the insurance front and um, um, the emergency fund, the point which one should clearly look for: use your debt very sparingly. Don't just for whatever your need, just don't use your debt and borrow from the credit card or the bank for just to meet your demand. The debt which you can have is for the home loan. So typically, home loan EMI should not be greater than 30% of net tax home salary. So if if you are earning 100 rupees, less than 30 rupees should be going to pay your home loan EMI. If the amount is increasing from 30, I think you should be very careful. Try to save more and do some kind of a down payment so that you can save more in the future and invest prudently. The second part, why I'm saying it should be less than 30%, because 20 to 30% of your income always goes into your monthly household expenses. And if your home loan EMI is higher than say 50%, the amount which you have to save is hardly 10 to 20%, and which won't help you to create wealth in the future. So hence, if your EMI, home loan EMI or any car loan EMI is less than 30%, you can easily save 40 to 50% of your income and use this income for future savings. Now, after this, whatever amount you have left, what kind of a retirement corpus one should think of? If you speak to any advisors, they will tell you 10 to 20 times of your annual income should be considered as a retirement corpus. But what I would recommend here is just to think of your annual expenses, and 30x of your annual expenses should be considered as a retirement corpus. If you have this kind of a corpus, apart from your, if you have a home to stay, uh, and if you have this kind of a liquid money, then you can clearly take a short of getting retired. So 30x of annual income. Now there is some kind of a calculation which has gone into it. This is a thumb rule which I want to give it at this point of time. Lastly, on the financial planning, the insurance or emergency fund, that which I have spoken about. At the end of the day, it all boils down to minimalism, which I clearly believe in. The less you take, more you have. Uh, so what this quadrant says? It just plots income versus your cost of living. If your income is high and your cost of living is also high, I think there is a less chance you have a financial security at the next after 10 to 20 years. So people who live far below their means always enjoy the freedom that busy people upgrade their lifestyle, which they can't fathom to. So always believe on this quadrant. So when you have a high income and a low cost of living, that's the ideal situation to have the wealth creation. In that case, you save significantly, you reinvest this saving, and try to make the corpus which can um, take care of your future needs. The low part, if you have a low income and a high expense, I mean that's the disaster we have. You just then you have to go to the boardroom, check where are the faults, why your high cost of living despite of the low income, and avoid that kind of a disaster. You will never get financially secured there. And the lastly, which is a low cost of income, low cost of living, and low income. That's a very tough task to have to create a significant wealth. Now, after this, you might be thinking it's too much focus on the money. Now, remember there is no correlation between the money and happiness. We just why we are talking about this is to have the financial security. The aim is to make the financial security, not the lots of money here. So after having the good corpus, uh, how should be you should be thinking about it. So let's take you have taken my advice and you have saved significant amount of money. Then what's the advice one should be giving to? So the firstly is don't work for money, make it work for you. So now what this says, we always believe that I have a 20 to 25 years of working life. I'll make significant money during this point of time. But during this time, one point which always we misses is the savings which we have done. If you haven't handled it properly, then in the future, whatever income you have generated, the same or equivalent or less than that you have expensed it out. So you don't have, even after working for 25 years, you haven't made that kind of a corpus which you required at the time of retirement. So allow your money also to work it for you. So we'll now understand how it should be done. So how to do that? So the creation of assets is the only thing which should be focusing on. Remember this, I'm saying creation of assets. Now a lot of people have the query about how you define the assets. So let's try to understand that part. Understanding of asset versus liability. So in a very simple or common terms, one which leads to your future cash outflow is a liability. Okay, so anything which you borrow today, for which you have to shell out a higher amount in the future, that's the future cash outflow you have. that's a liability. Just to give you a simple example, if you take a car and you take a car loan against it, so the say 10 lakh rupees of a car you have taken for the home car loan against it. In the future, when you shell out that money, you have to pay the interest out for that. So hence that's a cash outflow for you, and that's a liability for you. When I say the assets, assets are typically one which gives you a cash inflows. So whatever savings you have done, if you have put it in a fixed deposit, if you have put that into a real estate, so in fixed deposit you earn interest, in real estate you earn rental income. If you have invested in stocks or equity, you earn dividend interest, dividend from that stocks. And if you have the gold, which is a classic case for classic hedge for the inflation, the value of that gold will increase in the future, which help you to hedge against your inflation. So these are the typical assets you have. And what kind of assets one in talks about in day to day life, which are not actually assets, which are the depreciating assets. And the classic blunder would be if you take a loan to for this kind of depreciating assets. So you have a need for say mobile phone or watch or a car, but if you take a loan against it to fulfill your current luxury, and whereas your incomes are not that high, then it would only lead to your mismanagement in your cash flow in the future. So if you have enough corpus at the current point of time, and then you can of course go with the loan or the debt which you are thinking of. But if you don't have a current corpus to fulfill your luxurious demand, I would only advise you to stay away from the borrowings to meet your depreciating assets. Why I'm saying this is a depreciating assets? These assets won't lead to your any increase in your wealth. It just value erodes a day to day on a day to day basis. So how one should think of creating an assets? So I'll try to put these assets into four buckets. So first is your fixed deposit, second is real estate, third is equity, and fourth is commodity. Especially in commodity, I prefer the gold. Now when one think of creating of assets, one should have the focus on the urgency of that money which one has. So if you have any urgent requirement for the money during the next 12 months, then I would prefer you to put this money into a savings account. Don't put into any of the assets, because it's a very urgent require. So someone you have to pay to someone in the next 6 months, it's better to keep it in the savings account. But if there is some kind of a money which is required for the next 1 to 5 years, I would prefer you to put this money into fixed deposits, because that's a very near term need which you have. However, any money which you don't require for the next 5 years should be going into your equity allocation. Now that money which is there for the long term will help you to create significant wealth. Now the real estate. Now the in the real estate, typically how one should focus on any real estate which you buy. Firstly, it should be purely with the focus of your personal consumption. So you create a home for your personal need first, and then think of creating any other assets which you want in the future. So my suggestion would be, once you have your home, first home, then immediately don't go for the another home. Focus on the diversification of the assets. If I just want to see the average Indians wealth, how it's distributed, then a larger chunk of the their wealth goes into real estate. uh, Now this is very no one this is very counterintuitive. Just think of at the current point of time, whatever wealth you have, how much is the real estate occupying, how much is the fixed deposit, and how much is equity. It will give you an answer. So hence focus always on the diversification. Never have the higher allocation to any one of the assets, which can lead to some kind of uncertainty comes in. Then you don't there will be significant mismatch in your requirement versus what they are generating in terms of returns. And lastly, gold. Now, gold is very different asset as compared to fixed deposit or real estate or equity. Now, gold per se doesn't give you any cash flows, but it is a classic hedge against the inflation in times of war, in times of uncertainty, in times of pandemic, like current situation. The always price of gold increases, and if you have some kind of allocation, it will clearly help you to manage your entire asset allocation. So the four assets which I urge you to think of, depending on the urgency of money and depending on the diversification, FD, real estate, and equity, and the gold. Now everyone must be aware of how to do fixed asset, fixed deposit, how to invest in real estate, how to buy gold. Now equity becomes pretty difficult topic to understand at the initial stage of the working life. So I'll try to explain how the equity allocation you should be doing. So to understand that, you should be knowing what equity stands for, and what kind of investment which you are doing in during that. So what is equity? So let's try to understand equity in a very simple, very basic, in a common man term. So today you want to start a business. So business requires capital. Now, how this capital comes? So capital can come from the two aspects. Either you borrow the money from lender or from bank or from your friends. That considered as a debt. But when you put your money into the business, that money is considered as a equity. Now just take a simple example of, say, a fruit vendor. Now that guy is buying fruit from say APMC market at the cost of 1,000 rupees. Now to have that kind of purchase of goods, he requires 1,000 money. Either he puts that money from his pocket or from the someone's, by borrowing from bank or by borrowing from the any lender. Now, the moment he puts his own money, that is considered as equity. Now, after buying that kind of a fruits, he sell that 1,000 rupees to 1,500 rupees. Now, from the 1,500, he has generated 500 rupees of profit, and that 1,000 was he has invested from his money. He takes back that, or if he has taken from any lender, he gives it back at some kind of, after giving some kind of interest. So now this is the equity. Equity contributor earns profit, and debt contributor earns always the interest. Now debt whomsoever gives that kind of a debt earns interest in a very a standard typical way of say 8 to 10%, depending on the risk he is taking. Whereas in equity there is a higher chances of making a supernormal profit. So hence a lot of time people focus is on doing business. Why? Because the profits which can grow significantly over the period of time can really surprises you. So hence the concept of equity is the either the personal, single individual, or group of individual has to put the money into the business. That money is known as equity. Now, if someone has to put that equity into the business, what are the opportunity available? So for that, you have to understand the life cycle of a business. So when any business starts in the initial phase, they are at the very nascent stage, or startup stage. Now during the startup stage, there is only ideation or creation, ideation of a business to meet some kind of unmet demand in the market. So during that point of time, you shell out your own money. After that business grows, there is some kind of a certainty comes. Then there comes a few group of investors, like seed funding comes in, or venture capital funding comes in, or private equity funding comes in. You must have heard about startups raising $1 million funds, or $2 million funds from all these kind of players who are into the business of investments. Now this money is given by a few group of investors to the company to have a higher growth in the future. Now, as a common man, you can't participate in this area of the seed funding or the venture capital funding or private equity funding. After this business grows into a certain scale, now that on that scale they require huge money. Now, just think of it: uh, the individual investors or group of investors can't fulfill the requirement of a business with the huge money which they have from their pocket. So hence they have to come to a public market where they can raise significant amount of money from each and every individual which are there either as a retail investor or the institutional investors. So hence this at this point of time they come to a market where they can raise significant amount of money and where you can participate. Now, the moment the company is in a high growth stage or mature growth stage, they come to the public market where their share, the equity, which we understood gets listed and you participate in that, um, transaction. So let's understand, where to buy this equity. So the moment the business becomes very matured or at the high growth stage, they come to the market. They list their shares. So whatever equity they have, they list their shares on the stock exchanges. So we have in India Bombay Stock Exchange and National Stock Exchange, BSE, NSE, as we know. So these are only exchanges. They facilitate the transaction. There is some buyer, there is some seller who comes into the exchanges and trades the share. Now how one should look about this share? So equity, let's understand from the business perspective. Let's take an example of 10 students which comes into arrangement to start their business. Everyone puts 10,000 rupees of money to start a business, and hence they have a 1 lakh rupees of total corpus to start the business. Now, when they start their business with 1 lakh, they do some kind of a sales and then earn profit from it. But they want to make this business to another level. So at that point of time, private equity and venture capital money comes in. So with this 1 lakh, which 10 investors have put in, there are other investors which also comes in. They put say incremental 2 to 3 lakhs. So now total 3 lakh money has come into the equity. Now, at some point of time, either this investor want to get out of the business, so hence they list their company on the exchanges. Now, the moment this company gets listed on the exchange, you can buy their share from the exchange. So they might have to give their stake from the company. So the 10 investors initially which started their putting the money into 10,000, you can buy their share from the business and in turn earn the profit which company is making out of it. So that's the equity part. So whenever you think of equity investing, think of as you are buying the a share of ownership of the business. Don't consider it as some kind of gambling which you are doing in on the stock exchange. It's a always remember it's a place to create your wealth and not to make money. So don't consider equity investing as today you put some kind of a money and tomorrow you will reach you will gain out of it. So you have to give some kind of a time to it so that as the business grow, your profits grow in terms of dividend. Now the other way, so either start buying or selling your shares with the broker, where you start your demat account and start trading on that, or if you believe that you don't have that kind of a expertise, you give it to a professional experts who manage money on your behalf. So either you go to mutual fund or portfolio management services, PMS, which we call to manage your money. So since large part of your time goes into your work, so you don't have that kind of time to manage this kind of a money. So I would urge, if you have time of learning how to do equity investing, then only get into buying or selling of a share. If you don't, if you believe that a large amount of time gets into your job front, and then it would be better to seek the professional help like the mutual fund and the portfolio management service to manage your equity money. So then question comes, why one should think of equity if they don't believe how to do investing or how to do equity investing. Just look at the this chart, comparative returns which I have plotted of gold against Sensex, which is the equity investing index, and the FD, which is a fixed deposit. Look at the amount which you have put in 80s or 90s, how that amount has grown over the period of time. With gold and a fixed deposit, you hardly have made some kind of a return. But with equity, there is significant amount of wealth creation which you can, which you would have done. Hence, at the initial stage of your, life, during, they say, working life, say when you are in a 25 or 30 age, you should have some kind of a allocation, or rather a higher allocation to equity. The moment you reach 40 to 45 age, your allocation should shift to more of a fixed income, and more of a fixed securities rather than the equity, because there is some kind of a risk associated to equity investing. So now that, the question comes, so if I have a time, then how one should go about the investing. Now, investing itself is a topic, people do PhD on, or give significant amount of time to that. Even, after being into the markets for last 8 years, still I am a student of market or of investing, because there are n number of variables which goes into it. So it's become very difficult, for any knave or novice to start investing from the day one. I would urge you to learn before you start to invest in equity investing directly. So you start with your whatever corpus you have, with the mutual fund or with the PMS, in the initial stage where you don't have a much of understanding. But over the period, if you build that, then you can start with the direct investment in equity. So what kind of a knowledge one should have before investing in any business? So firstly is the understanding of a business is crucial one. So as we understood about that fruit vendor, so just take that example of what kind of a business he is doing, and let's take a understanding of that business. He is into a very simple business, buying of fruits and selling of fruits. But when you extrapolate it to into the economy, there are n number of other businesses which goes into, which have a very higher complexity. So if you take a business of, say, Britannia company, so they are into manufacturing of biscuits. So in that situation, you have to think of how the demand would be in future, from where they are procuring their all the raw materials. Is there any risk associated with procurement of raw materials, whether this demand will fluctuate over a period of time? So that kind of a business understanding you require, how much capital they are deploying into the business, and what kind of a return they are generating in that business, so that the profit which they earn, eventually you become part of that profit. So that's the qualitative understanding of any business. Second comes is a very crucial one, is the financial statement and statement analysis. Uh, every company have their profit and loss statement, balance sheet statement, and cash flow statement. It becomes very crucial for you to understand the nitty-gritty of all the statement, which will eventually help you in the understanding how this financial will move in the future, so that you can project that financials in the future and try to get the present value of that company. Third part is the risk assessment, which I think most of the population neglects about it. The risk assessment is very crucial one. You have to understand that what is the cyclicality of that business, what are the various factors, or what are various variables which can lead to the significant increase or reduction in their profitability. So that risk assessment is a very crucial one. And lastly, after understanding the business, financials, or risk, you come to the understanding of valuation, how you value that company. Now, I'll just try to give a simple example of valuation. Now, as we have understood the time value of money, let's apply that concept here. Let's take any company which has a cash outflow. So every year, suppose they have to shell out 1,000 crores of rupees, 1,000 rupees, and in turn they earn 1,500 of inflows. So net they make 500 rupees take home cash flow for the business. Now let's take this 500 cash flow for the next 5 years. So for every year they are generating 500 rupees of cash flows. Now this 500 rupees of cash flows for 5 years, if I just tell you, if I want to buy this business, what is the first thing, counterintuitive number which come to your mind? That is the 5 years and current year 500, so 3000 crore would be the value of that company. The point which everyone miss here is the time value of money. The 500 rupees which company is generating after fifth year, that 500 rupees is not same as what at current point of time. So you have to discount that 500 rupees to the today's present value of cash flow. So that time value of money formula which we have understood, let's try to reverse that. The present value would be the future value divided by 1 plus rate of interest raised to number of years. So that 500 in the fourth year is equivalent to 342 rupees in today's time. So if you add this present value of cash flow, that gives you the valuation of the company. So if this company is available at say 2000 crore equity value or market cap, how we say, then you will make money out of it because you are buying at a cheap. But if the same company is available at a higher rate, say 3000 crore, then there is no scope of making money out of this. So this is a very simple, very fundamental valuation which I have given. The rate of return which I have taken here is 110%. So in the real time, when we do valuation of company, there are n number of variables goes into it. There are n number of macro variables. How this rate of return has come. What are the demand projection which company is doing or which you are doing for the company. Say how much revenue they will do in future. How their cost of goods sold will increase. What kind of employee expense increase which they have to take. So those kind of assumptions goes into it. But this is a very basic valuation, one which can do to understand the how the company's valuation are done. So the moment I talk about the stock market, so there are various myths about the stock market. So let's try to understand how this what are this myths. So firstly, whenever I say that I'm into equity investing, so the first reaction which comes in, you are gambling. So please understand, investing is not gambling. So consider equity investing as a ownership of the business. So as we took the example earlier, equity money is the money which individual or group of investors put into the business, and at the end of the day, whatever profits they are generating, it is given back in the form of dividend to the investors. Now that if you understand from this point of view, then you can participate in the equity investing. So let's take an example. Everyone must be knowing about this classic bike, Royal Enfield. Now just think of we are in 2010. This bike used to cost you approximately 80,000 at this point, at that point of time. Now instead of buying that bike at 80,000, if you had invested the 80,000 in the company's business, like Eicher Motor is the company which makes the Royal Enfield bike. If you invested 80,000 in the stock Eicher Motor, just look at the kind of wealth which you have created. So in 2020, this 80,000 has become 25 lakh rupees. Now just see the kind of a wealth creation any equity investing can do, because at that point of time you must be knowing that Royal Enfield bikes are clearly the bikes for the today's generation. They want to have this kind of aspirational bike. So instead of buying that bike at that point of time, you could have make a significant amount of money. And in terms of CAGR, like compounded annual growth rate, every year you have made 41% in the last 10 years against the your FD rate of 5% or 6% or recurring deposit rate or 8%, whatever. So hence consider that investing as a ownership of business instead of a gambling. Second, a myth about the stock market: you can become rich overnight. Now, the understand it's not the casino where you go, you put your money, and next day you come out of it either with no money or with significant amount of money. Now consider equity investing as a very game of the time and the patience one. So time and patience are the virtue for you. If you invest today and you have a significant amount of horizon in your mind, say next 5 to 10 years you don't need money, and if you invest in the equity, then you can clearly compound your money through equity investing. Remember, the big money is not made in buying and selling, it's in the waiting. So time and patience are the one of the virtues which you require when you invest that kind of a money in equity. Remember, the time is one of the your greatest allies in wealth accumulation. It is one of the resource you will never get more in the future. So please keep it in mind. It's not like you will become rich overnight. It's consider it as one of the assets like real estate or like commodity or FT. The third myth or many investors tell me is investing require huge money. If I have a huge money, then only I would be successful in the market. I think that's not the correct way. Look at the power of small savings, power of small steps one can have. And this classic example you can give in you can use this in your day-to-day life too. Just focus on the improving a day every day by inch. So say whatever you are today, so just try to become a wiser 1% on a day-to-day basis. After a year's time, you would be 37 times of what you were at the day, day zero. And if you reverse it, if you are not learning on a day-to-day basis, there is no, a wisdom which you have generated over the year. Similar happens to the equity investing. If you have very small money, start with a systematic investment plan in the mutual fund. You put 100 rupees, 200 rupees, or 500 rupees every month, save diligently, and put that money into the market and allow that money to grow over the period of time. So this will help you to create a significant amount of wealth in the future. So hence, it is not necessary to have a huge money. You can start small. You can start with this systematic investment plan. Now, this is one of my favorite author, Charlie Munger, who is the partner of Warren Buffett, which you must be knowing in the Berkshire Hathaway. And this is the one thing I would urge you to just embrace it on a day-to-day basis. So what he's saying, spend each day trying to be a little wiser. You were, when you woke up. So what it helps you. The step by step you go ahead. Not necessarily you are in the sprint, but this discipline help you for the this discipline help you in the future fast foods. Now slug it out 1 inch at a time, day by day. So remember, at the end of the day, if you live long enough, the most people get what they deserve. So if you live long enough, say after 10 to 20 years of whatever investment which you have done in equity can generate significant amount of wealth for you. And the lastly, on the investing myth, which is there is many says it's very easy. Why one should do that kind of a study and put so much head into it? You just buy what's in the news. There is you get tip from all the brokers, your friends. Just do that. I would urge you to be very responsible at this point of time. If you don't have time or if you don't have that kind of expertise, seek professional help. I was always amazed by the human behavior. Whenever we feel some kind of discomfort in our health, we what we do, of course we do home remedies, but post that we seek the advice of a doctor. Look at the case of any legal aspect. Whenever you are in a legal trouble, you go and meet the lawyer. But whenever it comes to money, we always believe that we know everything about money and how to manage money. Uh, but that's not the real case if you introspect about it. So there is no harm in seeking the professional help. There are a lot of a registered investment advisor which who can help you to invest money into the equity. either through mutual fund or through the PMSs. So there are wealth managers also available. So you just take their help, because you have a very limited amount of time. If you are into your day-to-day business, or if you are in a job situation, then you don't have that kind of a time to study each and every company and put your money into it. So seek professional help for that. And one point which clearly I want to highlight here: remember that your reputation and integrity are most valuable assets, and it can be lost in a heartbeat, as Charlie Munger says. Why I put this picture here? Remember, whatever you know asset allocation decision you are making, whether it's in FD, whether it's in equity, or any other assets. Remember, you are not doing that for yourself. There are n number of other people, who are attached to you. You have equal responsibility towards them. I've seen many cases in my life, uh, irresponsible behavior in equity, especially they've taken debt or they've borrowed money from someone. They've put that money into the equity markets, without realizing how brutal markets can be, and they've lost n number of amount of money. Not their money, they've taken the loan from others, and they've invested that money, and they've lost that money. So not only they suffer, the entire family suffer. Hence, you should be very prudent about uh, equity investing. If you don't understand any product, any asset, don't I would I would tell you, don't invest. Just hold tight to your reputation. Whatever things which you are doing, that's fine. There is no need of getting into the greed of becoming rich on a day one. So just be responsible to your decision about it. um, So this was about the role of equity in the investing. It's a I've tried to speak about how one should do equity allocation. However, there is a lot of nitty gritties are into it. Um, you read about it. If you have any doubt about it, then you can easily contact me for that in future. I just want to cover the some aspect about the how the career in finance goes. Um, so typically, there are three buckets, which I take when one thinks of career in finance. One is the corporate finance, where if there is a business, you need some kind of a financial management or strategy and planning into it. You have to manage their treasury. So those kind of a business you can get into it. So that's a CFO level role or company secretary level role in the corporate finance. Second, when it comes to financial institution, so banking and insurance is another category where you can think for um, getting the job into the in the market. So banking and insurance typically deals with the treasury or sales front, selling of various products. There are actuaries which comes up with a lot of thinking about the product. So those kind of roles. And thirdly is the investment bucket. Is the portfolio management and investment banking, which deals with the managing someone else's money. So if you have someone else's money, you want to manage that. So there are experts available to that. So if you want to be a part of that, then that's a career can be done in that investment field. So what are the prerequisites for the if you want to be a in the field of finance? The love for numbers, and the you should be a very avid reader, because it requires a lot of reading about the current environment, global environment. So you should be on toes with it. And of course, number crunching is the prerequisite for it. Um, Currently you all are engineering students, so if you want to have that kind of a paradigm shift to finance, the only way you can do is you can go for an MBA specialized in finance or capital markets. If you have a CA degree, then you can easily pursue your career in finance. The other supplementary certification which you can do is of CFA or FRM. The core skills which are mainly required in the finance is the Excel and presentation skills, which are very key for your day-to-day operations. Now I've touched base on the career in finance. With the very limited amount of time I have, I just want to clear one of the key aspects of every student's life. They have a always they have a dilemma whether one should go about it MBA, or they should do masters, whether they should continue their job, or whether they should be doing the business or startups, whether they should work in India or overseas. The only advice from my side would be just be self-aware. Just try to introspect yourself, understand your interest, your strength, your likings, what are they, understand about the current environment where you are living, and then take a decision of one of the decision out of which you want to go about it. I know in the this must have everyone has told you that focus on your liking and those things, because it helps in the long run. In short term it doesn't help, in the long run it does help. But however, I just want to point out one thing here. If you have a risk taking ability, if you're if you are well to do, then you can focus on the business aspect, or you can start come up with the startup ideas or do that thing, if you have a risk taking ability. But if you doesn't have that kind of risk taking ability, then it's okay to do job in the initial year of period. I understand there is a huge, scope of getting a profit from the business, but anyways, you can, start investing in the equity while you are doing a job. So you can again become a part of a, any business. Just think of it like today you want to be, create a business like, say, Google or Salesforce. Since you can't, create that at this point of time, you can, of course, invest that money into that stocks, and be a part of that business, and earn the dividend out of it. So there is no harm in doing a job for the initial year, save money and be financially secure, and then pursue your passion. uh, you I always believe that whatever information which we get from the media, um, we we either we take it as a one of the advice and then take our steps. The self awareness is very crucial here. We always believe the grass is very greener on the other side. I've seen in my life various cases where the people who are doing their business, they are not happy with it. They either they are not liking it, or there are very uncertainty in the business, there are lumpinesses in in the business. So they always believe to do job is much better thing to do, because it gives you a constant cash flow of money every month end. uh, but when I speak to few professionals which are in the doing a job, they always believe I want to start my business, I don't want to work with under any person, or I don't want to take my boss tantrums. So I want to start my business, but that business also have that kind of uncertainty. So what we miss is the survivorship bias. What media reports every day, some company has raised $1 million or $5 million. So there are n number of other stories, or 100 stories or failure stories which they don't report. So we always believe that to start a business or to start a startup is a cool thing. But at the same time, when I see the business people saying the people for the professional, then I want to be on that side. There are again challenges to that. Look at the current environment in which we are living. Lot of uncertainty, lot of disruptions happening, lot of job cuts. It's not easy to get a job. So the only my advice would be, appreciate the luck which appreciate the destiny, appreciate your uh, um, karma, or embrace the karma, what be grateful to whatever you have at this point of time. Be self-aware, try to think what is good for your long term. But it's okay, if you are not doing anything which you are currently liking, but eventually with your savings you can have the financial security and then pursue your passion. Sometimes I just believe that it's okay, we have to do wrong things for yourself, just the betterment for others, or or for the right reasons. It's okay for that. And especially I would my advice to the current current year graduates, where there is a lot of uncertainty on account of pandemic. They are in a dilemma, or in a situation whether the companies will take them for a job role or not. The only advice would be just be faith, be hopeful, be optimistic. Use this time you have on focusing or the sharpening of your skills. I have a entire faith that one day you will prevail. Remember this thing, in any situation you are there, whether it's you are in a job situation or a business situation. The 20% is a technical knowledge which take you to another level. The 80% of time, your diligence, your attitude towards work, towards your life, the humbleness, the interpersonal skills are those things, personal skills, which help you in the long run. I think those things which equally you should be focusing on. Now, since I have touched base on the luck part or destiny part or karma part, then the question comes in, is effort a myth? No. No, if effort is not a myth, you should don't rely on the destiny part. You continuously work towards whatever assignment you are doing very diligently with the nimbleness. Start sharpening your skills in the whatever time you have right now. If with your hard work, which you put on a day-to-day basis, a very small step which you take on a day-to-day basis, eventually it will pay off. And that's my faith, and that's my experience. And yes, anything is possible, as Master Shifu says in the Kung Fu Panda. Anything is possible. Yes, it's possible, but when it's possible, when you have a inner peace for that. So how to get that inner peace? So we have understood about financial planning, how to create the wealth, but what's the true wealth according to you? Is that financial wisdom which you take over the years and hence build a significant wealth over the period of time? I don't think so. I think the philosophical aspect, the one of the professor or one of the author, Nassim Taleb, in his book Anti-Fragile, mentioned about the interesting concept via negativa. You just have to remove things from your life and not add things. And if you just do that, that clearly gives you the true wealth of your life. And these are the actual wealth which we misses out by focusing on other aspects, whether it's a worryless sleeping, clear conscience, gratitude, absence of envy, have the good relationship, no gym classes. You just have the physical, exercise or physical labor, so that you're physically fit, mentally fit, good digestive system. These are the true wealth. Give some time to it. Focus on this. Other things will be in place in the future. So now the secret to long and happy life. Now, as everyone must be expecting, I know I should give some kind of a tips to invest in equity. As I mentioned, there is no secret to long and happy life. You just have to believe. So what you have to believe? Just do this thing. I think you will be sorted in the long run. Just focus on yourself. Be self-aware. Just meditate, do yoga, pranayam, be fit, both physically and mentally. Focus on relationship, help others in any form, uh, read, learn new skills, and finally, find some purpose in your life. Find one, try to pursue that and fulfill that. I think that can be the one of the big satisfaction which you can get uh, in future, and not the financial security which you are currently which we are talking about. I think these are the two secret for long and happy life. Lastly, just want to touch base on why one should read. uh, you know As Charlie sir says, in my whole life, I've not known any wise person, who didn't read all the time. So just read as you can. It will surely help you in creating a wisdom over the period of time. These are the books which one should focus on. So from the equity perspective, those who guys who think they can easily learn these aspects, so these are the one of the finest book which can help you in the equity investments. And secondly, the books on the critical thinking. I think when even if one doesn't have a time for the equity investment, but these are the books which one should read to just develop that critical thinking part. I have attached the link towards it. You can find all this book in the PDF format on my Dropbox link. There are n number of other books also in that link. You can easily use that and just have wisdom which you require for your future. Yeah, I think that's it from my side. I think I've taken a bit longer, but still there are so many things to talk about. Um, I hope I have touched base on the each and every aspect which can give you as an anchor for your future. On this base, you can start building up upon for the financial planning. These are my credentials. Whenever you have any doubt with respect to any financial planning or equity investing, you can easily get in touch with me. I really thank once again for your patience listening. I know attention span of any human is only 20 minutes. I have taken a higher than that, but I hope it's useful to you. uh, yeah, that's it from my side.
I cannot begin to express how informative presentation that was, Mr. Nikunj. The way you explained those concepts made it so easy to understand. We are delighted to have you as a part of VReach. Viewers now have a few queries that they would want you to address. So let's begin the question answer session.
Yeah, sure.
So first up, we have a question from Pankaj Dwivedi. He's asking, should we invest for long term or short term? Which is the best and why?
I think one should always think from the long term perspective. Short term investing doesn't help in any way, any form. Why I'm saying that, as no one had think of a pandemic at this point of time, but suddenly we are in a situation, where everything is so uncertain. So during this time, market can be very brutal in a short span of time. So if you just think, I'll invest today and make money 30% or 20% in a 3 months time, I think that should not be anyone's focus. Consider equity investing as a long term investing, where you are putting that money which you don't require for say next 5 to 6 years. Allow that money to be into the business, generate significant profits out of it, and then after 6 to 7 years it can clearly increase your corpus. But short term nature of the mindset should not be there in investing.
So as you said, it should be long term so that it's fruitful. Okay. Okay, thank you. So next up, we have a question from our faculty, Shanta Sundur ma'am. She's asking, do you recommend to invest in MF in this pandemic situation, even in shares? She's also saying that news is that the market will crash. So what's your reading on this?
Yeah, sure. So that kind of a tool, just have that cope up with that kind of uncertainty, crashing, or the correction. I would recommend, if as a question is from the faculty, the large amount of their time goes into teaching, in managing other stuff. They don't have time to study the company and invest. So the mutual fund would be the ideal thing to go for. Now, in the mutual fund, I would suggest to go for the systematic investment plan. That is SIP. Um, uh, just connect the charge. So I'll suggest to go for the systematic investment plan because whenever market corrects, so there is a high chance you get a larger share of the business. So during the upside, you get you participate in the upside. When market falls, if you do systematic investment plan, that every month or every 2 months you will have the larger share of the business. Okay, larger shares in your demat account. So in a way, you just gradually put your money. Don't put the entire lump sum money into the market at this point of time. So stagger your money, stagger your investment on a monthly basis, so that that kind of a volatility which is there in the market gets normalized.
Thank you. So, as a student, even I had this question. So, two of our students, Shivam Singh and Dinesh Gulabni, are asking: is there any investment strategy that we can start at student level? They are also asking that as a student, where we should and how we should invest, as we don't have any idea about it.
Yeah, so again, it depends on the time which you have. uh, so if you think you can allocate significant amount of time towards equity investing, that you can start with the books which I've recommended. Start learning that concept of basic investing, and then you can start. That's one thing which you can do. But if you believe that you are currently in a stage where you should focus on your technical skills, and you should focus on your job, or work or assignments which you have taken it, then I would suggest have the strategy of investing this money into the mutual fund or any professional management services, PMS, which we say. If you have a large corpus, allow this money, for the expert to invest that money on your behalf. So initially, you should not focus directly getting into the market on the basis of your friends' tips that I like this stock, you should invest in that stock. So basically, you should have the proper understanding of the business. If you don't have time, then allocate your money to some professionals in the form of MF or in the form of PMS.
So, all the students might have heard that, and they might be mostly planning to do this investment. Okay,
Yeah. So
thanks
one
for
thing,
this.
one thing which again I want to talk about is how one should do investment in mutual fund. So there are n number of mutual fund available in the market, n number of schemes goes into it. So either you can contact the a registered independent advisor, or there are many websites which are in the market where you can just search about the various funds, how that fund is doing over the period of time, say 5 years, 10 years, 2 years, how the ranking of that fund in the various category. One thing which I talked about, valuation front, equity value, which I talked about. So what is the equity value of any company? So that value can be a higher or lower. So there are smaller companies available in the market, or there are larger companies available in the market. So if I say Google is a one of the giant of the world. But whereas say smaller companies, which is like smaller value company, so they have a higher growth potential. So you should allocate your money into large cap, mid cap, and small cap in the in your early stage of your career. Higher money should go into mid cap and small cap. But as you go into 40s or 45, the larger amount of money should go into the large cap money, because the risk in the large cap is not that high when it compares to mid cap and small cap.
Thanks for the great tip, Mr. Nichols. So the next question is coming from one of the faculty, Professor Sunny Nahar. He's asking, in the current situations, which option is better, a monthly SIP or lump sum?
No, so as I mentioned earlier, lump sum would not be the you should focus on. I understand that if you have a corpus, I would urge you to put a monthly investment into the whatever schemes you are continuing, or in the new schemes which you can take. If you are in the age bracket of say 40 to 45 or above 40, higher allocation should go into the large cap funds, but that should be on a monthly staggered manner, not the lump sum manner. If you have a huge corpus at this point of time, my request would be to put that money into the recurring deposit or fixed deposit for some time, at least in a shorter time, one year or 1.5 year, and from that you can have the monthly investment, because markets are um, the way in which they are rallying, it's not sustainable. So you might be enticed to participate in that rally, but eventually it won't benefit you. So it's better to put money into the staggered manner.
Thanks for the information, sir. Next question is coming from Pankaj Vedi again. He's asking, you have mentioned equity for 5 years, but if market crashes in the same fifth year of investment term due to pandemic and value of stock gets lower than our buy price, then is it we have wasted our time and money? He's asking.
No, so that's the as I mentioned, time and patience are the virtue. There are, and also there is a luck aspect to it. It so happened that after five, you have made significant amount of money, and on the fifth year, something like this can happen. The only way I would suggest is just be patient. Okay, eventually the returns would normalize. So in panic situation, don't sell your stocks or don't sell your mutual fund units. If you have currently made investment in 2 to 3 years ago, you wouldn't have any made any money in the market, because the economy was going through that slowdown phase. The business were not doing great, and hence profitability was not there. Allow that money to just grow in the next 2 to 3 years time. I think that return will surely come back. So just have faith in Indian economy, and have faith in Indian businesses. They will prosper in the future. But don't redeem any of your mutual fund units or stocks in panic situation. Just give some time.
And that might be noted by some of the people who would be interested in that stuff. So thank you, sir. Next up, we have a question from one of the faculty, Professor Vinita Mishra. She is asking, by looking at today's situation where gold price is at all-time high, will you recommend to still invest in gold, or are there any other options?
See, there are two point which I would consider here at the when it comes to gold investing. If you have a significant amount of a gold at this point of time, I would urge you to hold on to it. Don't sell at the current price. Okay, so just hold on to the gold, because it's the best hedge against the inflation. But the other aspect to it, when there is a such a panic situation in the market, or when there is a lot of uncertainty in the market, where economy is going through a lower phase, at that point of time, typically we have seen the gold does very well. So we expect gold to do well in the future also. So hence, whatever gold you have, just hold on to it. Now, for the whatever incremental money which you want to put it, so I would request that allocate your money, some to the equity, some to the gold. Don't put your entire allocation to one of the assets. So since I assume the real estate and FD would be a significant chunk, so the incremental money should go into SIP and gold. So now, if you want to buy gold, it is not necessary to go into the shop and buy the gold. Now you can buy the gold in the demat form also. There is also sovereign gold bond, which is given by the government, which gives you 2.5% interest rate on a year-on-year basis. At the same time, there is appreciation on the gold, so you can buy that gold bond also, or you can buy gold in demat form from the equity markets. So there is a ETF goes on, so exchange traded fund, where you just buy the gold in the demat form. You don't have to buy the gold in the physical form. So you can allocate your money both the asset class, some to equity, some to gold.
Okay, so as you mentioned, gold was one of the different options, buckets available while creating assets. So it's a good option. Okay, thank you for the tip, sir. So next up, a question is coming from one of the other faculty, Professor Asha Bharambe. She's asking, which portfolio management services would you suggest?
So actually, I'm not allowed to speak on which PMS services one should focus on, because of the my nature of the work. But I would suggest you to contact any of the advisors, because they can help you in understanding the philosophy of each and every organization. So you have many portfolio services currently available in the market. So if you have a long term horizon in your view, there are few funds available for that. And but if you have some kind of a 2 to 3 year plan, there are PMSs which can give that plan also. But just because of my nature of the work, I can't recommend any particular name for that manner.
Okay, okay. Okay, we understand that. So next up, the question is coming from Dipti Karani. She's asking, will this pandemic situation have bad effect in marketing after some months?
What I understand is from on markets you are saying, she was saying, right? So,
Yeah.
so of course, uh, economy and the markets, always at some point of time should go hand in hand. Okay, so if economy is not doing well, the market doesn't perform well. However, there are n number of other factors or variables which also functions about the in the market. So even despite economy not doing well, you have a surplus of money. So it's a classic demand supply equilibrium. So if there is a higher demand for a particular goods and services, the price of that goods and services will increase. So similarly, if there is a higher demand for stocks, the price will go up despite economy not doing well. But that phenomena is very short-term phenomena. Eventually, when company earnings or economy, GDP is not growing, your market doesn't perform well. So hence, we expect this kind of a whatever rally which we have seen in last 2 to 3 months. So market has rallied from bottom to 35-40%. It's not sustainable. So one should be very cognizant about this kind of they should not fall into this kind of a trap where this rally entice you to put more money into the market, but it can have a very significant impact on your portfolio.
And thanks for the answers, Mr. Nikhil. Next up, Ms. Hemkesh Raina is asking, how should one start stock trading in India? I mean, do you suggest some strategy for the beginners?
Okay. So, when you mention stock trading, I assume you are talking about trading and not investing. Now, trading typically deals with the short-term phenomena or short-term investing. I think first student asked me about the short-term investing or long-term investing. When it comes to investing, you should focus on a long-term way. But when it comes to trading, trading is more of a short-term phenomena. You buy today, sell in a 1 month's time, 2 months time, or 3 months time. In that, different type of skill sets required. Okay, so what I would urge you to do some kind of a course which are available in the market. So there is a technical analysis course which goes in in the market, which help you to understand how the price and volume move. On account of that, you can do that kind of a trading. So that courses which are available in the market, I think one of my references had mentioned leapup.in. They do that kind of courses. So in that course, you will understand how to do short-term trading. But I would urge you to go through that course. Do that kind of training for a significant amount of time before putting your hard-earned money. Okay, so don't get into the greed of earning money overnight. That's the only suggestion I have.
Okay, thank you. Next up, we have a question coming from Abhishek Chaudhary. He's asking mutual fund SIP or large cap company stock SIP, which is a good investment.
So again, it depends on your risk appetite. Okay, at which stage of the life you are in. So uh, as I said earlier, if you are in a age bracket of 25 to 40, I think larger allocation should go into the mid cap and small cap portfolio than the large cap. But if you are above 40, the largest chunk should go into the large cap ones.
Thanks for the suggestion. So next up, we have a question coming from Rahul Khatri and Mrityunjay Singh. They are asking, is intraday trading a good option for investing? Also, what advice would you like to give about trading, specifically about intraday?
So the moment you say intraday trading, it's not investing, it's a trading. So intraday trading basically deals with the price movement. They see what's kind of a news coming into the market. Basically a speculation. There is no fundamental analysis goes into that. So whether you buy A stock or B stock, it doesn't matter. So you just see what are the news flow coming for the A stock or B stock. If you believe that news flow is positive, you buy and you sell. That's the one thing from the news perspective. And secondly, from the chart perspective, typically the traders see the charts and how the price is moving on the basis of various patterns, various strategies. They take a call whether this company stock will go up or not in today's only single day's time. That's the intraday strategy one have. So for that, as I mentioned, there are various courses of trading goes into technical analysis courses which are available in the market. So you go through that training which help you to do trading in intraday also, or a 1 month, 3 month, 6 month also.
Okay, sir. Next up, we have a question coming from one of the professors, Professor Sunny Nahar. He's asking, is silver good option for hedge?
Okay, silver as a commodity, right? So typically, what we have seen over the period of time, of course, gold has been one of the commodity which has been a good hedge against the inflation. But silver as a commodity, it becomes difficult for to buy that commodity in the demat form. So you don't have much of an option there. So what you have to do is buy the physical commodity and just store it and wait for the time. My preference would be to have the gold. My preference towards gold would be much higher than the silver at this point of time. Although I'm not the commodity expert, so it's just my intuitive about the current scenario.
Okay, next up, Aniket Salgaonkar is asking, can you suggest some good pharma stocks?
I'm not allowed to because of the nature of my own.
Okay. And next up, Rahul Nailwal is asking, what are some of the unaffected sectors which would be worth investing in considering the current pandemic situation?
Unaffected sector. I didn't get the question.
Unaffected sectors which would be worth investing in considering the current pandemic situation.
See, whether the sector is affected or not affected, but I'm trying to understand the question. Say, from the consumer point of view, the essentials which we buy, whether it's Britannia's biscuit or whether it's Surf Excel, which are basic need. So that are these stocks which are listed on the market: HUL, Britannia, Dabur. Okay, where these companies are not affected on account of current pandemic, because you have the requirement of buying these things, and this company will do well in the future also. But there is a second part to it. So though the any business is good, but it's not necessary that business is a good investment. Understand, there is a difference between this. When I say the business and investments are different, the difference is the price which you pay for the business. Just to give you a very simple example, which is coming in on top of my mind. Let's take an example of simple pen which you are using. Any pen. Let's take an example of you know Reynolds pen or any Parker pen which you are using. Now that if I tell you that cost of this pen is 500 rupees, will you buy that? You won't buy, because the interesting intrinsic value of that pen is either 50 rupees or 100 rupees. 500 is too much to ask for. Okay, so despite that it has a utility to me, will you overpay for it? You won't, right? So similar goes into the investing also. Any business is a good, there is no doubt about it, but there is some price you pay for that. So just to give you an example, say, as I mentioned about the Britannia, so Britannia company will do well, everyone will eat biscuits, so that business will grow in the future. But should I buy at current price of say 3700? or I should be, doing proper analysis on the valuation of the company and then taking a call whether I should be investing or not. So the stock can be a good, business can be a good, but investing is another aspect to it. So you should be cognizant about it. You should not overpay for the business, because remember why you are investing in that business, to earn return. Okay, so now if you overpay for it, then you might have to sacrifice your return in the initial period of time, and then you will earn the return. So your net earning return from that business would be very minuscule, or 6 to 7%. So at this point of time, I would my strategy would be not to focus on the business which are already doing good, because they are already highly priced, whether it's a pharma stock or consumption stock, which we believe that they are very defensive in nature, but they are highly valued at this point of time.
Okay, so the concluding question, Vishal Bhandari and Pankaj Dwivedi are asking, do the US election has something to do with the market going up? How does the abroad market affect Indian market?
Yeah, sure. I think that's a good question. In the current situation, on account of current situation of pandemic, what US has done currently is they have printed money. Okay, so there were a lot of job cuts, salary cuts in US. So they started giving money directly in the hands of citizen. So this has led to significant amount of money getting pumped into the market. So despite the company doing well or not, everyone is having the surplus of cash, and that cash they want to invest in the equity markets. So that has led to significant rally in the US market, and some kind of impact which we are seeing in the Indian market also. So huge liquidity driven market currently, which we are into it. So of course you have to be cognizant about it. So now the US election is coming in the November. Now the one point, a critical point which I want to make here, when you are into the thinking of, or in the mindset of investing for the longer amount of time, this kind of events doesn't make much of a difference. Every year you will have some more kind of situation. In 2014 we had India's election, then in 2016 we went to demonetization, then we went through GST, then we saw ILFS crisis, then we saw current pandemic, then will be election. If I just want to take you back in the earlier years, in 2008 we saw the great financial crisis. The Lehman crisis burst. In earlier year, we saw tech bubble in 2000. In 96, we saw Asian crisis. So n number of crises we have seen. But if you have the long term horizon, it doesn't matter much. So you just have to be patient with the money which you have invested, and just make sure that money, you don't have a urgency of money in the near term. So this kind of events gets eventually eases out. You don't have to worry much about it. Focus on the business. The money which you are investing in the business, that business has a potential to significantly go up or not. Just to give you a tech example, we all are using Zoom, the Zoom technology stock. Just be observant about the current situation. If you believe the many people are using that, of course their companies earnings will grow. So that's a good company to be in. So you just have to be observant of the recent scenario.
Okay, thanks for the suggestion. So with that, we conclude our Q&A session. Once again, thank you, Mr. Nikunj, for addressing all those questions and providing some very specific and helpful answers.
Yeah,
We are
my
grateful.
pleasure. Yeah, it's my pleasure. I think I want to thank everyone again for patiently listening to my presentation, and I hope I have tried to answer your all the queries. At least not the all the answer all the questions. At least some base on which you can build in the future. Thank you.
Yes, so we are grateful for the time and effort you took to share your thoughts and experiences with us. So with that, we come to the end of the webinar. I would like to thank all the participants who attended this very detailed session and made it successful with your presence. I would request all the participants to kindly fill the feedback form provided in the description. Your feedback will not only encourage but also motivate our team. You would receive the e-certificate for the session after filling the feedback form. For past sessions, if you missed us, you could visit Recit's YouTube channel or our website, recitreach.ves.ac.in. And also, upcoming event details can be found on the VReach's website. With this, I, Faizan Qureshi, signing off. Also, don't forget to join us for another interesting session tomorrow by Mr. Mayank Kothari on risk analysis and beyond failure. Have a great evening ahead.